So why don't we get started here? I'm Sam. Hi there, and this is Andrew, our Chief Investment Officer.
Good afternoon.
I'm the person with the most words and the least intelligence. Andrew's completely flipped in the opposite direction. He's the clever one who doesn't say quite so much. So I will run this presentation. I've got some slides to show you, and that'll take about 20 minutes. And then we'll get on to questions and answers, because we're very happy to answer any questions about any aspect of the financial markets, of simplicity, anything that you're interested in. So let me just go to a share screen here, and I'll get a presentation up here when I can find it. There it is. And we'll push, excuse me for a second. I just want to push play on this. There you go. There's a push play button. There we go. All righty. Can you see that, Andrew? Yeah, all good. Okay, great. So, let me do this. Let me, oh, sorry, I apologize. This thing's not playing the way it's supposed to. Let me, I'm just going to get the expert in the room here. Won't be a second. Oh, all right. Okay, there we go. Apparently, I'm starting at the bottom of the presentation. I go to the top. Boy, there's some clever people here. Okay, here we go. Right. So what are we all about? We use this slide just to describe what is our motivation, and it's really important. We call ourselves a dignity company. We want people to have choices in life, because when you have choices, you have dignity. And so what do we do to give people choices in life? We make them more money. So in spite of the fact that we're a charity which owns a non-profit, we are entirely about making our members wealthier so they have more choices and dignity in life. And if you have a look at what we do, we have this phrase called simplicity for life, which is really that we're going to be around for 100 years. We're structured just like Southern Cross. We're a charity which owns a non-profit. So we will never be sold as a company. And so over the course of New Zealanders' life, we'd like to be there in the form of KiwiSaver funds all through your life, investment funds as you grow up a bit. We're going to start looking at income funds, and there'll be some announcements on those in the next few months. And obviously, we just started doing mortgages for first home buyers, and now a major program in terms of homes for rent. The underlying theme there is we're a non-profit social enterprise. We want to give the best value for money to our members, and obviously give 50% of all fees to charity. So that's just a brief reminder of who we are. And just so you understand where we are right now, these are today's numbers. We now have 136,000 members. We're saving them about $34 million a year in fees. That's an awful lot of money every day. And we've given $5.5 million to charity now, and that is increasing at approximately, let me think about it, about $6,000 a day now. And we have 4.6 billion of funds under management, so very fast growing. I want to talk about the general market environment first of all, and this is the slide I had at our last presentation, and it was headed up inflation, interest rates, and war. And you know what? A few months later, this exactly the same slide with exactly the same title, because these are the things that are dominating how the world thinks about it, and it looks pretty gloomy out there. And it is, the word that I would use to describe the global economy and the markets right now is, and it's going to sound like a crazy word, but funky. It's kind of unpredictable. There's a lot of stuff which tends to come in from various angles that are hard to absorb and hard to work out. And we've just seen this with Silicon Valley Bank collapse in the last few days, completely out of left field. People weren't expecting it, and then it has repercussions all around. So I guess, for a little while still, I think the one thing you can be certain of is uncertainty and unpredictability, and that really influences how you should invest, and we'll get onto that in a minute. Let's talk about what we've done. This has to be the US stock market right up until yesterday. As you can see, in a global context, it goes up and down all over the place, but it trends up. And the reason that it trends up is because, capitalism works. It's the economic organization except for all the others, as Winston Churchill said. And stock markets go up because companies make more money, and companies make more money because people work harder and there's more competition and so on. As you can see recently, right at the top right-hand corner there, quite difficult to understand, and markets have gone down. But in the context of history, to do is sort of markets going and real away, and they're completely unpredictable. In fact, if anyone knows when the next well, we're in one now, but if anyone knows when the next recession is, please let us know. But in history, that they come along reasonably regularly, but some quite big periods in between recessions. We've just had a very big one. They're unpredictable, and of course the markets are unpredictable too. The other thing is interest rates, which is obviously the big issue here. This is the New Zealand 10-year bond rate, the 10-year government stock, what the government pays basically to borrow money from you and I. This is a 25-year history that we're looking back there. You can actually see that, like it really dipped down massively to 2021, but around about 4% here over a 25-year period is actually not that unusual. We're back to what you would consider to be almost like, let's call it normal. You can expect interest rates to trend down if we go more into a recession. Right now, what you've seen is quite a bit of weakness in a lot of parts of the world, but the labour market holding up, right? And you've obviously seen a lot of inflation, which puts upward pressure on interest rates as well. And in New Zealand, particularly, obviously with the floods, and I don't know if anyone's been and tried to buy fruit and vegetables in the supermarket lately, but it's just incredible, the inflation price pressure there as well. That will keep interest rates up, because what happens is when inflation gets out of control or rises, the Reserve Bank is tasked with bringing that inflation down. What do? They put interest rates up, so mortgage rates go up, so borrowing rates go up. And that means that it cools down the economy, because people aren't spending money on discretionary stuff like going to the restaurant or buying a new car. They're paying down their mortgage, or they're spending, they're effectively have less money to spend, and that slows the economy down over time. So the Reserve Bank is going to put up interest rates until the point at which it feels like the economy is slowing down, and then it will presumably slowly let air out of the balloon. When will that happen? We have no idea. We never have any idea. If you can predict when that's going to happen, let us know. But if you had a look at this chart right now, if I'd shown you any economist 5 years ago that this would, was this likely to happen in New Zealand, I can pretty much bet, obviously didn't speak to everyone, but I pretty much bet every single one of them would have said no. They would have said it's a almost impossible possibility. But of course it happened. So financial markets are inherently very unpredictable. So we don't know where they will go. I would say this though, and Andrew can speak to this more authoritatively later, but that we've actually got now what you call quite a lot of gas in the tank in terms of the ability to slow down. These interest rates are going to start slowing down the economy. You've seen it with building companies falling over, for example, and you've actually seen it with Silicon Valley Bank too. One of the reasons was high interest rates caused them to go bankrupt because of the way they managed their investments. They've made some very poor management decisions. But in the environment of higher interest rates, you're starting to see the economy slowing down and businesses going bust. And that means that probably the Reserve Bank has a reasonable amount of gas in the tank now to actually slow down the economy and then also slowly let interest rates off when and if it slows. So what can I do? It all comes back to, as an investor, what can you actually do? Well, I think there's the one chart I always put up, and I won't put it up this time, is you've just got to diversify. And the reason you've got to diversify is you have no idea what's coming around the corner. Did anyone predict the collapse of Silicon Valley Bank? Did anyone predict these interest rates going up? Did anyone predict COVID? All of these things happen all the time, and they come at you in a very unpredictable manner. And that really the number one thing you can do to protect yourself against all of that is to diversify your investments, so that if any 1, 2, or 3 things go down, could be whole sectors that go down, you are not going to be, basically bankrupted or see all your savings wiped out. So diversification is the first thing, and of course that's why our growth balanced and conservative funds and both KiwiSaver and investment funds have 3,000 investments in 23 different countries, so that they're very diversified. Here's the second thing you can do is focus on fees, and we put this up every time, but folks, it's so important. The average New Zealander saving in a KiwiSaver balance fund on a salary of $40,000, $47,000. If they put 3% into the fund each year, if you compound those things up, and these are numbers from the sort of website, not ours, you will see that the average person pays more in KiwiSaver fees than they do in power bills and mobile phone charges over their lives using current charging rates. As one of the reasons why the banks are so profitable, because they have so many KiwiSaver members that they're making so much money from. So focusing on fees is critical. It's why we, as a non-profit, owned by a charity really focus on fees, because we know it's the number one factor to influence how well you will do in your investments over your lifetime. The other thing is actually using the power of compounding interest. And I've used this last time, and it seems to be sort of a bit of an eye-opener for people. And I apologize if you've seen it before, but if you've seen it before, it's worth repeating anyway. What would happen if you saved a cup of coffee a day from the time your child or grandchild was born until the time they were 65? Let's just put it into a growth fund, just a stock standard growth fund. We're not even going to assume our low fees. We'll just use the average market fee, which is much higher, but a cup of coffee a day. So why would you do that? It's because as the price of a cup of coffee roughly tracks inflation. So you're putting the same amount of money in terms of your net worth in if you save a cup of coffee. So when a cup of coffee costs $2 and the average salary was $20,000, if the average salary goes up to $40,000, the cup of coffee goes up to $4, it means you're putting the same amount of your salary in. So you're inflation adjusting your savings. So what happens if you do one cup of coffee? Well, at 25, this is using, right? This is putting into a KiwiSaver growth fund, which you would for a young kid. It assumes a 5.5% after-tax return. So tax is paid as well, right? So that's $35 a week. That means they would have $71,000. That is a huge leg up in life in terms of a first home deposit. And if you didn't take the money out and you just left it in there, remember, in a tax-adjusted dollars, you'd have $429,363 for retirement. It's one cup of coffee a day. That is the power of compounding interest. That's why that guy on the right, Albert Einstein, said the eighth wonder of the world is compounding interest. So that's what you can do. Carry on saving a little amount every day. And in fact, when you see financial markets go down right now, you are getting more for your dollar. It's like buying shoes on sale. You get more for your buck. So actually, regular saving when markets are down is actually more important. It actually contributes more to your wealth than saving when markets are going up and everyone's feeling okay. So is the future scary or cheery? It looks pretty weird and funky out there right now, but I just wanted to remind people, and I'm sorry I keep on doing this, but we are seeing this at Simplicity every day now, the power of New Zealanders saving and what it is doing. Here is what KiwiSaver is doing. This is funds under management. It's about $90 billion now. It could be $200 billion by 2030, $900 billion by 2050. So there's a lot more money is going to come into the economy. And Andrew, we just keep on, it doesn't matter whether financial markets go up or down, we just keep on getting money coming in because you are saving every day. We're going to show you what sort of things we're doing with that money. Obviously, the lion's share of it is going into those 3,000 investments in 23 different countries. But KiwiSaver managers are able to do some interesting things, and we're hoping, well, we are leading from the front on this in terms of what we do with other money. But the problems of having too much money are way better than the problems of having too little. And in New Zealand's economic history, we've usually had too little money to do what we wanted to do. We are where Australia was in the 1980s. They now have trillions of dollars saved. Look how much wealthier than us they are. The other thing I just want to say is we're obviously here for good. And here's an example of what we're doing with all of those billions of dollars that you give us, because lion's share of it goes into the standard investments, but we're able to make some very long-term investments on your behalf, which are great for returns, but also great for New Zealand. And, you would have heard about Simplicity Living. We announced this about, Andrew, I think it was about a year ago now. And now we're actually about to open our first village. It's the one on the top left-hand side there. It's called Kupanga. It's in Point, England. And we have two villages which will be opening, one there and then one in Onehunga in Auckland. They will both have together about 169 homes. They will be built for 100 years. In fact, the picture at the bottom, you'll be wondering what that is. That is a third development that we have now got consented, and we'll start building in a few months in Oaraka, which is otherwise known as Mount Albert, or close enough to Mount Albert. And that will be another 70 homes that we will be building. We actually have now got under contract the land for over 800 homes. And so what are we doing? We're building these homes for 100 years. We will build them, own them, and operate them as long-term rental homes. Another option for New Zealanders. Retirees could live in it knowing that they would be safe and there forever, not have to pay a huge premium if they move to a retirement village operator. And also for young people and so on. And and you can have the elderly on the ground floor if they don't like the stairs, and young people up the top. We're aiming for carbon neutral. In fact, we're actually aiming for carbon positive. We've decided since we last spoke to you that we will be planting 1 native tree per apartment per week to do a carbon offset there. We also use what they call low environmental intensity carbon, or low E carbon. And we use bricks, obviously, there as well, which are very environmentally friendly. Most importantly, also, a lot of these homes that have been previously built by the company that has now become Simplicity Living, a lot of them never switch their heaters on because they're so warm. They have concrete and brick, what I call massive thermal efficiency. And because of concrete walls, they're very quiet too. We waste that as we count the skips that go off the site versus, comparative building sites next to us. And we're bringing in affordable long-term rents. If you looked on Simplicity Living on our website now, you will see what we're building, and very shortly we will be renting out Kupinga, and they're in the order of $400 to $425 for a 1-bedroom flat, and about $450 to $520 for 2 bedrooms. You can hire car parks separately as well. Most importantly is they're bigger, they are warmer, they are drier, they are more solid, and of course will be a very, very reliable landlord as well. And as an investment, to give you an idea as well, for those of people who are interested in investment returns, and I'm sorry, I'm going to use some technical language for those who understand it, but the 100-year internal rate of return on this is between 6 and 8%. That is highly attractive versus the equivalent, or fixed interest investments. And because we capture so much of the development margin, remember that no one's making any money here. We build them. So if they value up, our members get the benefit of that value increase. We're building them at about 30% below market costs at the moment, about $2,500 per square meter is our build cost. And that means that on a new development, when we build something new, once it gets ready, once it opens, the internal rate of return is much higher. We're looking at projected IRRs of somewhere between 15 and 20% for new developments. That's a very good return for members. That makes perfect economic sense. It's where you would want some of your money. And also bear in mind also that with rental returns, it's like mortgages. It's the last bill you won't pay, right? So the cash flow keeps on coming every week. So when you get a market downturn, it helps soften the effect of that downturn on your fund because the rents just keep on getting paid. Yeah. So that's the first thing we're doing. Second thing is we continue to do low-cost first home mortgages. We've done about $135 million worth of them now for members. That orange line there hasn't actually, I apologize, hasn't been updated for our last rise, but the whole market's gone up as well. As you can see, we consistently come as one of the lowest cost providers. Remember that our orange line there is a floating rate. Those other ones, the green line is a 1-year fixed, the yellow is 2-year fixed, and the blue line is what the banks charge for their floating rates. So what's the idea behind that? The idea is simple. We take all of that profit that the banks make, that profit being the difference between what they pay in term deposits and lend and mortgages. We take that profit and we give some of it back to our members in terms of increased returns and some of it back to our borrowers in terms of lower borrowing rates. So we take all that fat and we split it and our members win both ways. So that's what we're doing. We're going to carry on doing that. We will be in this game for a very long time. We're upgrading our systems and we're looking actively now at offering 1-year fixed mortgages as well as floating as well. So there'll be some news coming up on that. The next thing we do is we help build community housing by giving your money to some community housing providers. This is effectively government guaranteed lending, so it's very low risk and it gets houses built for those who need it. So we'll certainly be one of the bigger funders of community housing in New Zealand right now. Very proud to do it, and it's a really good investment too. We also help startups to grow. This is, we have committed $100 million to Icehouse Ventures. These are the companies that we are invested in via them at the moment. They're really cool, high-tech startup. Most of them will fail to succeed. There will be a handful of them that will do spectacularly well. And as long as you have enough investments and are diversified enough, you'll get enough winners to more than make up for the losers. And most importantly, this is KiwiSaver money going into high-tech startup companies to help them grow. It's a fantastic investment, and it's a really good thing to do. It's what you can do when you're here for good. The other thing we do is via education. We have distributed about 120,000 printed copies of this book last year. It is also available online and free to all members. So just you go online and download it. And if you want some free copies, send us an email, and we send boxes of them to schools and workplaces and so on. So very happy to distribute it. It's free. You can read it in an hour. It's been written by me, which means it is going to be in very simple language because I don't like the complex stuff. And we've got some marvelous feedback on it as well. So very, very happy to help you there if you'd like to get access to it. The other one is via the Simplicity Foundation. We've now done about $5.5 million to them. It continues to grow each day as we grow, focusing on youth, environment, climate change, and homelessness. And also, we've now planted, since I put the slide up, we've now planted 135,000 trees because we do one per member. And now that we are planting one per apartment per week, if every apartment that we are renting will be planting 52 native trees every year, we expect that number to get very big. To give you an idea on the Simplicity Living, our long-term goal is to build, own and operate 10,000 homes in New Zealand. That means we would be planting 10,000 native trees a week as well. That's fantastic in terms of carbon offsetting. So I am going to finish there. This has been the quickest presentation I think I have ever done, and I'm going to stop sharing there, and then we will get to Q&A with Andrew. You'll be running it, mate. And if there's any complex questions, they're all yours.
Yeah, thanks very much, Sam. That was great. Yeah, thank you all for the questions that have come through so far. We'll get through those. Please feel free to put more on the Q&A as we go. And some really good questions already. So first one is, are we in the early stages of another GFC with bank failure in the US? Which is a great question. And I would rather not be put on the spot to actually give a definitive answer, but the issues with Silicon Valley Bank appear to be fairly isolated. There has been a run on the shares of the regional banks in the States overnight, but that's about share capital, not the reserves and assets that the banks own. Silicon Valley were had a very concentrated lending portfolio in high-tech companies, all of whom had problems once interest rates in the States began to rise and have risen quite sharply. They would no longer be able to raise capital the way they had been, so they began to take their deposits out of Silicon Valley. And the problem for Silicon Valley was that a lot of its investments had been effectively overvalued in their balance sheet, not for any scurrilous reason, but simply that they hadn't revalued a lot of their long bond investments. And so when they came to liquidate those, when they were forced to liquidate those, it was clear that they didn't have as much reserves as they had appeared to have previously. And so when they finally had to come and try and raise some more capital from their shareholders, the alarm bells rang very loudly and everybody tried to pull their money out of them, which unfortunately meant that they had a liquidity crisis as opposed to an asset crisis as such. The Federal Reserve had to step in and bail them out. So, as I say, quite a specific and quite an isolated entity. There were some alarm bells ringing prior to all of this anyway. It does not appear to be a symptomatic problem in the US banking system. And the Federal Reserve and the insurers have stepped in very quickly to ensure that depositors can get their money out of those two entities. The other one being Signature Bank, which was a lot smaller but tied up in the same thing. And so at this stage, there's a lot of turmoil. There's been a dramatic swing in interest rates in the US. In fact, the US 2-year Treasury yield has fallen the most since the early 1980s over 2 days. But that's all about Federal Reserve expectations. The market was expecting the Federal Reserve to increase their short-term rate by another 50 basis points, maybe even 0.75% in the next review. That now has swung around to the expectation that they probably won't do anything at all. And that complete pivot has meant that the markets has reacted dramatically, probably overreacted, but for now, it swung around a massive amount. That's had a depressing impact on interest rates around the world, including here, but particularly in the States. And so the next few days will probably continue to be volatile, but at this stage, it doesn't appear to be anything like a GFC. There doesn't seem to be any real systematic problem with the system. Time will tell. We'll give you a time if we think it's changed. Sorry, Sam.
But with the rising interest rates, clearly it's slowing down the economy. You're seeing some stresses come in there, right? So if you've got a mortgage or you've borrowed money and you're worrying about where interest rates are going, you'd have to say, I mean, we have no idea, but you'd have to say the balance of probability now is that interest rates are much closer to the top than they were even a couple of weeks ago, right?
Yeah, and that is the key. And this is what the markets are saying, is that the failure of Silicon Valley is symptomatic of higher interest rates, and that's likely, as you say, to have a much broader impact on the US economy. The key to that is that this, as I say, is quite isolated. So it'll be interesting how it pans out. But certainly for now, the market's no longer anticipating the Fed to put rates up at the next meeting.
All righty.
Okay, completely different subject. Another great question, though. There was some suggestion late last year that we would address the tax leakage issue in our international asset investments. We've previously or currently using Vanguard Australian Unit Trusts. And we've been fairly candid about the fact that that leads to some tax inefficiencies. Sam, do you want to address the...
Yeah, so look, folks, in the next 2 months, you're going to see more announcements from Simplicity than you probably have ever seen. I think this will be the most, let's call it innovative, disruptive period in our history since we started. And so there are going to be a lot of announcements. One of them will be in this area. We have spent an awful lot of time coming up with what we think is a fantastic solution to this. Basically, the tax leakage issue is that when a company pays dividends overseas, you should get a tax credit for it. It kind of gets stuck in Australia because of the nature of the funds that we bought into with Vanguard, and we bought them because they charged such a low fee. It was worth doing that when we started. Now we have economies of scale. We can eliminate that. We'll give you some idea of what that means in terms of enhanced returns and lower fees, but it does mean both of those things. Your fees can be lower and your returns in theory can be higher. So it's really super exciting. And that's just one of a handful of announcements that we'll be making in the next couple of months. We started out, of course, last week with our first, our fifth fee cut in 5 years. But it's the first time that we cut our management fee, and that was across the board. And we now have economies of scale as a business. We have been running what we call a cash surplus for quite some time now. We've spent that to build up a rainy day fund. We just want to have a contingency fund. That's a sensible thing to do as a business, so that we can now afford to run ourselves for a very long time, even if we receive no revenue. And now we want to pass on all of these, the vast majority of the economies of scale to our members in the form of future fee cuts. We need to save a little bit behind to help expand and grow the company. We have to hire people and buy computers and all that sort of thing. But this is a business with massive economies of scale now, and we want to pass them on to you in terms of continual fee cuts. So watch this space. I'm super excited. I almost want to tell you now, but I'm not going to. I'm not going to be allowed to. Andrew will clip me around the ears if I do. But we have some very, very good news coming up in that area pretty soon.
And some of the questions coming through address exactly those. But one that we haven't discussed, Sam, which is an interesting one, is whether we will consider removing the $1,000 minimum on our investment funds, as banks remove their opening minimums and AMP has as well. That's an interesting one. We'll have to discuss that offline, I guess.
Yeah, look, let's have a discussion of that offline. That's an interesting question. I think we should revisit that one, yeah.
Sure. Next is, when do you think we will be able to have a high growth option? I have a 30-year time horizon, really want to get set with heavily equity exposure. Sam?
Oh, I so want to tell you, but I'm not allowed to. So watch this space. That is one of the other announcements that we have pending in the next month or so is going to be in that area. So I think we'll have if everything happens the way we want it to, we'll have some very good news for you there shortly.
Yeah, not too long at all now. Will the Simplicity Living apartments be built to universal design so people of all abilities can age in place?
Yeah, that's a great question. The answer is not all, but nearly all. So to give you an example, Kāinga Ora, the government, I think, have what they call a universal life mark standard, which means that people in wheelchairs or with mobility issues can get in and out and move around in the apartments. They're building 15% of their new homes to that standard. Simplicity Living intends to build 85% of our homes to that standard. And that's not just because you can give, and it's wonderful to be able to give people wheelchair access and so on, but bear in mind, of course, that as the population ages and so on, it just becomes a little bit harder to walk around, you know, a few more ramps and a few less stairs and all that sort of stuff. So we're going to build 85% to that standard. It costs just a little bit more to do that, but it's absolutely worth it if you're going to own it for 100 years. And in fact, by the way, you'll notice that when you get into one of our apartments, and I sincerely hope you get to see them, we're going to start to do some open days so you can come along and have a look. But you will notice that when you're in there, the doors are a bit more solid, the ceilings are a bit higher, the tiles in the bathroom are up to the wall, the showers are a bit bigger, the verandas and the decks are a little bit bigger. And that's all about living comfortably long term. If you build a home to sell it quickly, it's all about the bling. You may want to look good, but without home, because once you've sold it, it's someone else's problem. But if, like us, you're going to own it and rent it, you want it to be about the livability and the enjoyability of that experience. And that's just about the graciousness of space and the niceness of the quality of materials. All of those things that cost a little bit more and which you wouldn't do as a developer because you want that to be profit for you. But for us, that's spending it so the tenant experience is great, and that means they pay their rent, and that means our members make money. Yeah.
Great. Thanks, Dan. And sort of almost following on from that, does my diversified fund have an allocation to the rental properties, and will you make the rental properties an investment option?
So good question. So Andrew, you're a little bit more of the guru on this than me. It's in the asset allocation of rental properties across our growth, balanced and conservative funds. Could you run that through that?
At this stage, the property fund is an investment for the balanced funds and the growth funds. It's not in the default fund, and it's not in the conservative funds. And the reason it's not in conservative funds is primarily because at this stage, we're still in the early stages of the developments, etc., so that the investments, as much in the development stage of the properties as it is in the rental, we expect to be able to, once the portfolio is developed, then I would expect the conservative funds to have an investment in there too. And similarly, as part of our default provider appointment, we agreed with the supervisor that at this stage, the property fund was unproven to the degree that they would rather it wasn't in there. Again, I would be very surprised if that's not changed fairly soon. But then, as far as
property, will we make them an investment option, a separate investment option? The answer is not yet. You know, we're going to be around for 100, 200 years. We've got a lot of time to get this right. We want to make it, before we make it an investment option for everybody out there as a separate investment option, we want to make sure that it's bedded down, running well, high visibility as to what's happening, lots of track record and history there. So not yet. Is our intention long-term to do that? Probably yes, it will. It would be a wonderful option for people because it will hopefully return higher than term deposit rates and be, pardon the pun here, safe as houses as an investment, right? So, it's a really good investment, but what we just want to make it a small part of everybody, the balance and growth funds to start off, and then it'll expand over time.
Right. One simple one I can cover. The website states that the Simplicity floating rate is 585, not 515 as per the graph. That's right. Sorry, the graph hadn't been updated for the most recent change. We spend a lot of time considering where we pitch our interest rate, and obviously there's quite a long lag between when we change it and when it actually impacts our borrowers. We will be reviewing it again the next time the Reserve Bank reviews its OCR, and that's our regular review, just to see what other entities have done with their rates in the meantime. our most important consideration is that we have to be looking after our investors. We want to make sure they're getting a good return for their money. But equally, of course, we do consider where borrowers have options elsewhere. Next one, thanks, great presentation, thank you. Is the Simplicity tree planting predominantly in New Zealand or overseas?
Well, it's all in New Zealand, and it's all native trees, and it's all eco-source native trees. So, we've taken the advice. We go via use Trees Account, so we give them money. Trees Account know what they're doing. They get, armies and groups of volunteers together, and they provide the trees to plant. And then, over time, I think we're the third biggest donor now of trees after Air New Zealand and Mazda, which is cool. I'm more ambitious than that. I want to be number one, although I think beating Air New Zealand is going to be a bit difficult, but we'll give it a good go. So all in New Zealand, all native. It's just the right thing to do.
Great. Question from Carol, and we'll preface this with, we of course cannot give you any personal advice, but her question is it ever too late to start investing for the long term, e.g. in your 60s, when you don't know how long term you're going to be?
Sure. Well, Carol, I'm not an actuary here, but I'm going to give you some really good news. If you've already lived to your 60s, you have a very high probability of living much, much longer. So, the average life expectancy is because, tragically, children die and young people die, and that brings the life expectancy down. But if you reach 50, your longevity is going to be quite long. I think it's in the mid-80s. And if you live to 60, who knows? So on that basis, then you may, obviously we don't know and we can't give individual advice, but if you could possibly be living for decades, then yeah, it is worth thinking about investing for the long term, for sure.
Thanks, Sam. I'm happy to answer this one. Question from Jack. How does appreciation of Simplicity's rental properties benefit members if the properties will never be sold? The key here, Jack, is that they form an asset of the fund. And so if that valuation increases, the value of the assets increases, that means that feeds through to the unit price of the fund. So it is our intention to hold these things forever. But if they go up, and we expect them really to go up with at least inflation, and that in itself is another investment characteristic that we're really positive about, is owning these things for the long term. They feed through to a unit price, which therefore feeds through to the members.
It's kind of like owning your house, right? And you've always got a reasonable idea of what it's worth if you sold it in the market today. And of course, that's like that valuation. And we actually get registered valuations on these properties regularly. That feeds through. So you benefit if the value of these properties go up.
Yeah, so we get a quarterly review of all the valuations that we will do once we have these things. And if there's perceived to be a significant change in the market intra-quarter, they'll get reviewed at that stage too. I've got to try and remember my numbers here. The question is, did we lose money on the Silicon Valley Bank failure?
Yeah, I think I can remember them. So Andrew did some work yesterday. The average person in the conservative fund, because Silicon Valley Bank was listed on the US Stock Exchange and we owned some shares there, and they also had some bonds that they'd issued as well as a bank. The average person in a conservative fund, for every $100,000 they had in their conservative fund, they would have lost about $10. For every $100,000 in a growth fund, they would have lost about $20. So nothing, tiny. And it's certainly a much, much smaller amount than, the markets move around each day. So yes, there's some, and that would be the case, I think, for many KiwiSaver funds who would have been, if it was in the US S&P 500, a lot of them would have owned it.
Yep. Now, this one is a little bit more difficult to answer. Question from Fiona. Will you be able to transfer your KiwiSaver account to an income fund annuity as you age?
Right. So Fiona, we don't do annuities. Annuities are kind of like an old-fashioned way of providing income. We tried actually for a while to do annuity, something called a guaranteed income fund, but we found out that the economics of it didn't work for our members. So you will be able to transfer to an income fund, and I can't not allowed to tell you right now, but there's going to be an option for you, several options for you, hopefully fairly shortly. So you'll be able to do that. The type of income fund will depend on how much you're prepared to accept things going up and down a bit too, because if the income fund owns government bonds or local authority bonds, they can go up and down in value on a day-by-day basis. So the answer is, in principle, yes. And in practice, just watch this space. We'll hopefully be announcing something shortly for you.
Right.
In fact, we have, I'm just so excited. I think we're going to have an absolute category killer income fund coming up for you by the end of this year with a very unusual name.
Yeah, that's still open to debate. But anyway, I'm going to need to control you on this one, but so keep your answer to as short as possible, Sam. But from Steve, please comment on the ridiculous profits that the Aussie banks are generating here.
Sure. Look, I'll just give you some numbers, Steve. It's $1.1 million a day. It's $1,950 on average per New Zealander per year. It's about 20% more than the Australians make out of their average Aussie. They make out of an average Kiwi 20% more. And it's about 30% more than banks would make internationally. So are they crazy levels? Yes, they are. Very encouraging to see today. It looks like the government is hinting very strongly that there'll be a Commerce Commission inquiry into bank profits. If that happens, that is exactly what's needed. How was that, Andrew?
That was very good. Very good. You're well learned in this one, don't you? Question from Louis, and I'm not sure about the first bit. Do you need any home lenders? So what's your assessment percentage rate? Also, what percentage of KiwiSaver funds are lent out to your first home buyers? Okay, I can start from the end and say that out of the conservative funds, Louis, it's about 7.5% of the fund maximum, going down to about 5% in the balanced fund and 2 or 3% in the growth fund, which means that, I mean, the mortgage book is still only somewhere between 125 and 150 million. It's a relatively small proportion of our overall assets, but the conservative funds are the ones that have the most invested in there. Sam, you know?
Yeah, I think by assessment rate, Lou, I think what you're talking about is what percentage deposit do you need, and that's a 20% deposit minimum. We're a conservative lender, so we make sure that there's a high degree of likelihood that the person's going to be able to repay their first home, because remember, it's our members' money that's being lent out here. So we have a fiduciary responsibility to our investors to be very conservative lenders. And clearly there are plenty of members that do. I think we have about 230 first home loans out there right now, and we just carry on making more and more month per month. It's sort of the tortoise strategy. We grow slowly. Our members benefit. We haven't had a single default on any of our mortgages, and of course the borrowers benefit too. The last time we did the numbers, they were saving about $100 a week in interest payments, which is fantastic.
Thanks, Sam. Another one here. Will you share learning, so people building their own homes for 30% less?
30%, yes. Yeah, sure. I think that's how do we manage to build at 30% below the market? And yes, so the answer is yes, we will. We make all of our intellectual property, the plans, the construction methods, and so on, available to anyone who wants them. That won't suit a single home builder, though, because we build out of concrete and brick, and that's not really the ideal materials for a first home, standalone home. But if it's a multi-unit residential, we build from 3 and we're looking to build up to 11 stories. Concrete and brick are fantastic for that. So, but we've been to the whole industry and said, listen, we don't care if we're competitors. We just want New Zealanders living in warm, dry, affordable homes, because we're building them, including the cost of land, for about $500,000 each. We want you to be able to do that. So slowly but surely, and it is slowly, but the building industry is beginning to cotton on that we kind of know what we're talking about here, and they're starting to pay attention. Yeah.
Thanks, Sam. Just a thank you from Carl, and it'd be great for your son's new account. Yeah, that's, I mean, as I say, we will discuss that definitely. Can we do this more frequently, Sam?
You can. If you want to hear Andrew and I, you won't hear me, but you may want to hear Andrew once a month. That's absolutely fine. I think we can do that. Didn't mean to post that. Not sure what that means, but anyway. So this one again,
might need to control you a little bit. But anyway, which of your funds meet ethical investment standards according to those recommended by Mindful Money? A subject that we've had a fair amount of discussion on quite recently.
Yeah. Well, those standards, of course, differ with Mindful Money. They just tell you what percentage of the companies they don't like in your funds. And so we rank very highly. I have heard that we're like way up there. And of course, that's just exclusions. That doesn't include all the, here for good stuff that we do, like rental homes, community houses, charitable contributions, all that stuff. So, so the answer is, yeah, we rank very highly with them.
Great. Question from Dara, and actually, I mean, my team here would be better answering this than me. But if you're switching from your KiwiSaver from ASB to ourselves, and you've been told it can take 10 days, your money is not out of the market for 10 days. It may be out of the market overnight, but when the transfer occurs, it actually happens almost simultaneously. The IRD system now is very efficient, so I need to check my details here, but certainly you're not out of the market for 10 days, but it can take that long for ASB to do the processing before it gets transferred to your fund here. You should be able to see it in your ASB login until the day before you get transferred across, and then 2 days later you should be able to see it in your Simplicity account. If you want more details on that, our team answer the email info@simplicity.kiwi. So if you'd like confirmation of that, then please contact them. Next one, Sam, is from Fiona. The Simplicity portfolio will change as the increase of housing stock increases. How else will Simplicity diversify as the housing stock increases? Yeah,
sure. It's a great question, Fiona. We're already obviously very diversified with 3,000 investments in our average diversified fund, KiwiSaver investment funds. But we're always looking for more ways to diversify because it's such a cool thing to do. So the housing, built-to-rent housing is one, doing mortgages is another, getting involved in venture capital via Icehouse is another, and we're also now starting to buy minority stakes in family-owned businesses where we will be a very, very long-term holder. Don't want to sit on the board, don't want to tell them what to do, just want to sit there quietly as a minority shareholder of a very successful long-term business. So always seeking to diversify within New Zealand. And what else would we like to do? Well, I think in the infrastructure area, we would like to be able to diversify at some stage. That requires the government of the day to want that to happen, but I think that would be another area we'd look at as well. Yeah.
And Fiona, just to reassure you that this diversification, we're fundamentally a passive investor. We're only taking these opportunities in fields where we believe there's a decent risk reward basis for doing so, and it will only ever be a relatively small proportion of your investments, because we're very aware that we've got to make sure that liquidity is considered at all times. So it's not taken haphazardly at all, and it's in conjunction with our supervisor public trust whenever we do any of these moves away from the norms. Question from Chris: will the floating rate ever be available to members who would like to swap to Simplicity? I already bought their first home before this option was available.
Yeah, no, that's a great question, Chris. That's called refinancing, right? Refinancing your mortgage at a lower rate. And if Simplicity said that we were into the refinancing market, we would be swamped with demand within 24 hours because our rates are lower. The answer to that is maybe in the future, if we have more money to lend, and that is a function of how much we grow as a business and how much is allocated towards mortgages. Right now, we are actually satisfying all the money we have to invest by just doing first home mortgages to our members. If we run out of demand there from our members, then we will look at refinancing. How we will allocate that, I don't know, because we will have huge demand, because we will be, if not the lowest cost lender in the market, then one of them. We would certainly, as always with us, we like to offer it to our members first. But, we have 135,000 members, and a lot of those have a mortgage. A lot of them have a mortgage. So the answer is we don't know yet. It is on the radar, but we need to grow more first. So if you can help us do that by just talking about us. Because the more we grow, the more money we have to invest, and the more we have to lend on mortgages and build to rent housing and investing in startups in New Zealand, everything that we are doing and want to carry on doing in a much bigger scale.
Great, thanks, Sam. So that's the last of the questions that I've got have come through. If anybody has anything they'd like to ask us, I think we're more than happy to stay online and answer.
Yeah, totally.
In answer to that last question, can you provide a synopsis of the presentation on your website, plus the significant questions and answers for those who don't have time to listen or are unlikely to? Actually, the Q&A thing would be an interesting one.
Yeah, absolutely. Look, yeah, no, totally. So if you send through an inquiry to info@simplicity.kiwi, ask for the presentation, we'll get it to you.
And we'll do an attempt at covering off all the key questions that we've answered as well.
Cool. Great. Well, thank you very much, team. Thanks, Andrew.
No, thank you, Sam. Appreciate it.
Couldn't do it without you, my friend. Alrighty. So this is lovely. We've got some great feedback. I'm delighted to hear some of the questions are about some of the announcements we've got coming up. Watch this space, folks. Open every email. Tell people about it, because you're about to hear a raft of really significant news from us in the next couple of months. And yeah, thanks very much for your attention. All. See you next time.
Cheers.
Bye-bye.
Bye.
Cool. Let me.